messages, as I mentioned in the initial remarks. Why is the economic growth going to perform better this decade, remainder of the decade? And what the reforms of the last 8 years have done to make sure that happens? And beyond 2030, what will be India's medium-term growth magnets? And finally, as we look ahead to 2047, what else and what more we could do to realize India's full potential in the Amrit Kal. And if you look at the, is it moving properly on the screens? Okay, thank you. The survey looks ahead to the medium term because the pandemic response and recovery phase is over. In fact, chapter 1, the title itself says, State of the Economy, Recovery Complete. And therefore, after a long time, we have banking, non-banking and corporate sectors with healthy balance sheets, and they are ready to borrow and lend and invest. So we don't have to speak about pandemic recovery anymore. We have to look ahead to the next phase of India's economic growth process. So why is economic growth going to be better this decade? In order to look ahead to the future, we always have to first look back at the rearview mirror. Let's rewind the tape a little bit. What happened in the first decade of the millennium was a lot of optimism about BRICS economies. By 2002, balance sheets were lean and mean. Companies were willing to borrow, invest, banks were willing to lend. So leverage ratio in the corporate sector and in the overall non-financial private sector rose very sharply in the first decade. And it got to the point where the credit to GDP ratio in actual terms was much higher than the trend in the first decade of the millennium. That is what you see. The middle hump is basically actual credit GDP ratio was well above trend, and it persisted for a long time. And because it was quite well above trend and also lasted longer, naturally it led to a period of excess borrowing and excess lending, and the second decade was a payback time. So India went through a classic financial cycle, credit boom and credit bust, and this is not something new for the world. Every time you go through a financial boom and bust, it does leave its impact on economic growth, and that is what happened to us, especially in the second half of last decade. And you can see this here. Look at this chart. From 1980 to 2000, the bank credit to GDP ratio was roughly around between 25 and 30%, and then it jumped from 25 to 55, 60%, and spent the second decade of this millennium hovering in that range. This is the digestion process. So there was massive expansion. Remember, this is a ratio. GDP went up, but the bank credit expanded even more than GDP growth, and naturally, such a big spike within a space of 10 years, what we could not achieve in the previous 20 years, naturally had to lead to some kind of a credit indigestion problem, which had to be adjusted in the second decade. And now, that process of indigestion that has been sorted out, and the balance sheets are repaired now, and banks' non-performing ratio, whether it is scheduled commercial banks in general or public sector banks, they are lower now. And you can see that also banks have done so partly through recapitalization, raising fresh equity, and also through higher provisioning. So bank balance sheets are repaired, and that is why you see that in the credit growth picking up. You look at credit growth across sectors, agriculture, industry, services and personal sector, housing loans and car loans, etc. The growth rate is now sustainably above double digits. And this is a sign that this is what we were missing towards the second half of last decade because of balance sheet issues. So to quickly summarize exactly what happened was 2005 to 12, credit boom that led to balance sheet stress later, phase of a higher non-performing assets due to past forbearance, and then by the time we could repair, just want to leave one statistic with you. The non-financial private sector leverage ratio, debt to GDP, went up by 40 percentage points in the first decade, from 2000 to 2010. And from 2010 to 2018, it came down by 30 percentage points. And by 2018, that was kind of done, it had bottomed out. But before we could start expecting corporates to borrow and banks to lend, came the collapse of IL&FS and some housing finance companies. And by the time we got a grip on that problem came the pandemic. That lasted 2 years. And then 2022, we had the commodity price shock and synchronized monetary policy tightening after a very long time in the developed world. So it's a case of balance sheet stress followed by successive one-off exogenous or external shocks that have basically prevented the impact of economic reforms pursued by the government on economic growth. We would have seen the results already, but for these successive one-off shocks on the back of a fairly large credit boom that turned into a bust. The reforms of the last 8 years, which I just now mentioned to you, basically spans multiple dimensions. It is not purely about economic reforms for higher growth. It is also about inclusive growth, financial inclusion, banking cleanup, the creation of the digital public infrastructure, which I think I'm going to talk about a bit later as well, and contribution to healthy India, ease of living, and continuing on to the next slide, physical infrastructure creation, facilitating investments, transparent taxes and tax administration, ease of doing business, and farmers' welfare. So broadly speaking, about 10 areas we have covered here. These reforms were happening even as the banking cleanup was going on. And this episode between 2014 and 2022 has a lot of parallel to what happened between 98 and 2002 as well. Then, as now, the banking system was coming out of an NPA crisis, and there were sanctions on India after the nuclear device was tested in Pokhran in 98, and deleveraging was getting on in the banking and corporate sector. There were 2 successive droughts. The technology boom ended, internet boom ended in 1999-2000, and the US recession followed, 9/11 happened. But amidst all these shocks, interest rates were deregulated, privatization was pursued vigorously, and the first foundations of the insolvency and bankruptcy regime was laid with the asset recovery mechanisms. The FRBM Act was introduced, and today's digital infrastructure, which we talk about, the foundation for that was laid with telecom reforms in that era. But obviously, there is a lagged effect for these reforms to show through in the data because underlying conditions had to turn favorable. We talk of public digital infrastructure. Okay. I think it's not enough if I just look at the screen, right? Yes. I'm reminded of what economist Joan Robinson said in the 1960s about India. Whatever you say about India, the opposite is equally true. That's what she said. And so anyway, the parallels to the 1998-2002 period to this period is that even as a crisis was being addressed, economic reforms were pursued, and when underlying conditions turned favorable, the lagged effect of reforms showed through. That's exactly what is reflected, for example, in the IMF forecast, and that is what we expect in the medium term as well. The lagged effect of the reforms will show through because in the last several years, the full effect of the reforms could not be felt in the data because of successive one-off shocks. And that's why we talk about the medium-term growth magnets for the economy.